NHR, the non-habitual residency scheme. Today we're going to talk about how NHR works. What is it? How does it apply to you if you're an American expatriate, as well as some of the other factors that I have learned in the time that I have been a practicing financial planner in Portugal. So let me go ahead and share my screen here. This is a presentation that I felt was necessary because it has taken me a few years to learn how to adapt the financial planning process that I have been practicing for a few decades in the United States to individuals that live here in Portugal. So just some quick disclosures. None of the presentation I am about to share with you constitute legal or tax advice. If you contract with us as a financial planner, then there are some strictures that may eventually apply. But the information that is contained here is intended to be strictly educational. Go to our YouTube channel where hopefully this video will be showing up so that you can get some additional information on some of the other topics that I'm creating recordings around. In case you don't know me, I am an American expatriate. I am an immigrant, and I have been a financial planner for a few decades now. Originally from San Francisco, California. I've also lived at times in the American Midwest, and totally passionate about what I do. I'm a certified financial planner who also holds a designation that I earned during COVID in global financial planning. So the rough outline of what we are going to be talking about today: what is NHR and how does it fit into our calculations when we create a retirement plan? We're going to talk about the necessary conditions for filing NHR, deadlines, which deadlines apply to with regards to NHR. And also I found it useful to think about a few other deadlines as well. And then we're going to talk about the benefits specifically for Americans. We're going to take some breakout. We're going to do a quick example of how this works. And then talk about what to think about as we approach the end of the 10-year tax holiday and how we're going to live here once we're off of the NHR system. So let me go ahead and jump into it. So how do we understand NHR? What is it? Well, it stands for non-habitual residency. It was founded in 2009, which I found interesting that here in 2023, it's really only been around for about 14 years, and it allows inbound migrants. I know expat is the more popular word, but we're migrants. And the individuals that it applies to are folks that Portugal wants to have in the country. And because they need individuals with talent and or, that's right, capital. So capital and work is what it has always been about. And so the benefit is intended to attract individuals to live here and to have a 10-year period to get used to living here. So that creates various tax exemptions. So you get exemptions on various types of foreign income. Again, the intent here is not to give you tax benefits across the board, but to not slam you with the much higher, relatively higher taxes that you will become liable to as a resident of Portugal full time. So your income, your rental income, dividends and interest, and capital gains on the sale of certain assets will be granted to you when you have NHR. You'll also receive attractive tax rates on various kinds of foreign income, on pensions, on specific high value activities that you perform here in Portugal. So there are various professional and executive roles that you can inhabit here in Portugal. You need to figure out what those are, and those roles will also receive a value added tax benefit as well. Portugal has a 0% death tax, the controversial estate tax that is levied in most countries. It does not apply here in Portugal. Although if you are looking to come to Portugal because of the 0% estate tax, you should be advised that there are, of course, various other ways that you can be attached. There are estate taxes, but they're hidden. But that is something, of course, that will continue to apply to you during NHR and after. The interaction with double taxation agreements. This is just to say that NHR is nice, but it's even nicer when you understand how the double taxation treaty between the United States and Portugal works. And you need to understand that interaction so that you can get the best from this system. So why would it be necessary? Well, we know why it's necessary, don't we? Because you and I, if we're interested in Portugal, understand that Portugal has a lot of things going for it. And I'm not just talking about the sunshine. So Portugal has featured highly in global rankings recently as one of the best places in the world to retire. It's got quality of life, i.e., doesn't have a gun problem right now, and people tend to be pretty friendly on the whole. The quality of life is good at an affordable rate, safety and stability, as I just mentioned, and the healthcare here is actually quite good. Of course, everything is worth something if it doesn't cost too much. So if you have to pay taxes at the standard rate, taxes in Portugal, the socialist country, are of course going to be higher. And how much higher? Well, first off, we have to point out that your income is going to be coming to you, it's going to be coming to you in dollars, hopefully, but you're going to be spending it in euros. And so as of this recording, which is the 22nd of August, euros are trading slightly higher than the dollar. And that is usually going to be the case. But the far more relevant fact is that taxes are just much higher. If you look at the specific tax brackets here, you'll notice that the tax brackets for the United States are much larger. In order to get into the top tax rates in the US, you've got to be making more than $450,000 per year. And I think we can all agree that is a lot of ducats. That is a bunch of money. In Portugal, the tax brackets that you must assess here, if you're making more than 75,000 euros, it's about $80,000 per year, then you, my friend, are in the top marginal bracket. And so for an individual making $100,000 a year, and this is a rough calculation, I have to say, but I have double checked this with some Portuguese tax advisors. Yeah, you're paying about twice as much money in Portugal as you are paying in the United States in taxes. So that is a problem, or it can be a pretty big problem. And so here is a page that I ripped directly from an active financial plan that I produced for a client. So this individual is 66. He wants to retire now, and he wants to live in Portugal now for 30 years. He wants to spend $4,000 a month, which I think is totally reasonable. If that $4,000 is money that you're just spending on lifestyle, that's right. So this financial plan is showing you what is the lifestyle expense after you've paid for either your mortgage or for your rent. So $4,000 a month is going to cost you over the rest of your life. If you die at 90, it's going to cost you about $1.38 million to lead this lifestyle. If you were to be faced with the additional expense of the normal Portuguese taxes, that is going to add another $420,000 to your financial plan. So instead of having to spend $1.38 million out of your coffers, you are now going to be, that's right, you're going to be paying $1.8 million. And of course, I don't need to tell you the likelihood of succeeding under this program is that's going to be harder to make your money last. So with NHR, and even if you weren't interested in finding any other strategies, what you're saving is $420,000. You don't need to look at this chart for very long to understand that this is a pretty good deal. It's a very important deal, and it allows you to also get your affairs in order during those 10 years so that you can get into retirement in Portugal and feel comfortable with it. But if you just look at these two charts, I mean, man, oh man, is the NHR benefit a great thing? You betcha. It's a great thing. It's astonishing how much money can be saved during those expensive first 10 years of retirement. So how do we apply for this benefit? Well, the application process is pretty straightforward. but I am surprised at how many people don't succeed at getting this piece figured out. I have some very smart friends who haven't taken this 3-step process. Number one, you must become a resident, a tax resident. Okay. And so to be a tax resident, you must have lived in the country for the 183 days, half of a year. And you will have met the substantial presence requirement for becoming a Portuguese resident. Or you just need to change your address at Portal das Finanças, which typically coincides with having been here for half a year. So once you change your address to a Portuguese address, you're essentially going to be a tax resident at that point in time. Number two, okay, you've checked the box. You've become a tax resident. Number two, you have to have also met this requirement. You're not a habitual resident, right? So that's in the name. It's a non-habitual resident. And what a habitual resident is somebody who's been in the country and been a tax resident within the last 5 years. Why does that exist? Well, if you think about it, if that didn't exist, you could just leave Portugal and then you could come back within a few years and you could reset the clock on NHR. So most of us don't have to worry about this, but you just have to ensure that you have not indeed been a tax resident within the last 5 years. And then you got to log on to your Das Finanças portal. That's the www listed here. And you need to find the request page and you have to click on a few buttons and you have to file your request. It's very simple. It's surprisingly, shockingly simple, given the number of people that I have met that have paid more to have a respectable, but sometimes expensive assistant help them to file their NHR. That's it. It's a fairly straightforward process, but you got to be aware of the deadline. And there's one big deadline that I've met some people that have failed to be aware of. So the first deadline that we're all always thinking about as American taxpayers is the April 15th US tax filing deadline. We got to continue to be aware of that. So that still shows up on my list, because as a US tax resident who has not expatriated and given up your passport, you are going to have to continue to file your taxes, just like everybody else in the United States, or anybody that's lived in the United States and hasn't surrendered their passport. But then you got to worry about March 31st. This is the official deadline for filing for your NHR. As we'll talk about in just a bit, there's ways that you can repeal. You can try to appeal a failed deadline, but don't do it. March 31st, the year following you become a tax resident, this is when you need to file NHR. June 30th, that's your tax filing deadline. And so I think it's called a Formula 3 or something, has got to be filed by June 30th every year. You can now do this without assistance, although if you're a new expatriate, I would advise you to seek somebody qualified to help you with at least your first year tax return. And then August 31st, this is the last day for you to pay the IRS or for the IRS to pay you. And in case this is the first time you're hearing IRS, yes, it is confusingly the exact same acronym as it is in the United States of America. But yeah, August 31st, which as of this recording is about a week away, is the time when you can expect to have the funds due to you direct deposited back into your personal account. So deadlines. We all know somebody who is bad with deadlines. Majest prazo. This deadline is pretty hard and fast. But yes, if you fail to meet the deadline, there have been certain circumstances where taxpayers have successfully disputed their missed deadline. Like a lot of things in life, you can achieve things if you're willing to A, pay for them, and B, get a lawyer. So you can Google these processos below. There have been some Americans that have successfully fought the state and got their NHR status back from the jaws of defeat. But my take, of course, not to sound like a broken record, just don't do it. Don't tempt fate, because it's far easier just to go ahead and file on time. The benefits for passive income recipients, as a rule, the benefits of NHR broadly apply to all kinds of foreign income, including real estate income, your income from W-2 employment, 1099 income. The source of income does have to not originate from your kind of tax havens or blacklisted countries. I'm thinking of the Isle of Man and Jersey, the Cayman Islands, some of the favorite places for people to put those assets that they'd rather not declare. Don't mess with the Portuguese tax authorities on these things, because they will come after you, just like the U.S. IRS. And let's see, there's other exempted income. Yeah, these other forms of income won't be taxed at all when you are filing under the NHR regime. Some of them will actually attribute to you after NHR has passed. Another thing to know about exemptions is that while these exemptions will take out the taxes, you're going to be exempted from paying taxes on some of these things, they won't actually change your modified adjusted gross income. So that's important to know, because if you have $150,000 in income and the first $75,000 of income are going to be exempted due to the NHR, the higher rates are still going to apply to the remaining amount of income. So if you're exempt up to the second level of this pyramid, where you're being assessed a 23% tax rate, you're not going to have a big hole that brings the entire pyramid lower. So there are circumstances where you're going to actually have to pay in the United States and take a credit to offset that. But remember, the marginal rate can sometimes be preferable to an exemption. Come and talk to me, or talk with one of your tax advisors if you disagree, or if you want to have a longer conversation around it. Capital gains is a brutal subject. Now, we're not going to go too much deeper into this. I have made this slide as complete as possible so that you can pause this or look at this later. Number one, capital gains are going to be assessed at a flat 28% rate under NHR. You're not going to get away from capital gains as a consequence of NHR. Super painful. There is some conversation around this that is extensive, wherein there is a clause in the double tax treaty that has been written between the United States and Portugal that says that there is a chance that you can get away from paying capital gains. There is even a famous arbitration case, which has been won by an American who basically sued the IRS under the double tax treaty. And this American won, but don't mistake that for a precedent that you can point back to at any point in time in the future. Essentially, this is not tax court where a case has been waged and won. This is arbitration. Okay, arbitration is different. And what this essentially means is that every time that you want to say, guys, there's a savings clause I'm going to invoke, I'm going to pay 0% on my capital gains, you are not going to be let off the hook immediately. You are indeed going to be faced with the same task that this one individual was. You're going to have to wage a brand new arbitration case. And so I have told my clients many times, if there is a way that we can reshuffle your deck, we can restack the cards in a way that we can get away from, we can basically solve these problems before they become a problem, then let's do that. Let's not head into the contentious issue of arbitration court just because. And if we want to, then please, I would advise you to know what you're heading into before you go there. Some, not very many people, but some people like to delay their NHR filing for various reasons. If you're filing a golden visa application, then for sure. If you're filing the golden visa, you're saying that you're not living in Portugal anyways. You're starting the clock ticking on residency now, with the intention of moving to Portugal later. But for some, they also wonder whether they should then become a tax resident. It seems natural enough because they have income coming from an investment that's here. No, you're not a tax resident because you're not a resident. So don't apply to the Office of Finances. Don't try to become a tax resident before you have to, because why would you? You're basically then wasting the NHR period during the time that you're not actually living here, if indeed you were allowed to register as a tax resident here at all. They probably would let you though, so I wouldn't tangle with this. Stay away from being a tax resident until you have to. Partial first year, sometimes you're a little bit on the cusp. Maybe you've been here for 80 days. You get here in, October, and you're really Dudley Do-Right, and you want to file to become a tax resident. Not so fast. Don't do it if you don't have to, because why not give yourself another year of the NHR? Okay, so here we're talking about optimizing. And so there's times where you really want to think through your decision to change your address, for example, with the Office of Finances, if you're on the cusp. And then for family reunification, there's situations where you may be coming and reunifying with a family member, and as you work through your immigration filing, you think, oh gosh, maybe I should change my address at the same time as I'm working through my visa issues. Maybe not. There's opportunities sometimes to get an additional little bit of time by just waiting to become a tax resident for a bit of time. So my favorite subject actually is the after the 10 years period. And so I think about this as this question that we have to ask one another, like, when you get married, are you all in? Are you all in on being a Portuguese resident? Well, I mean, in this case, it's not like getting married, unless, of course, we want to extend the analogy to mean that we get to date for 10 years. Which, anyways, I'll leave all jokes aside for this. So 10 years is a long time. So you have 10 years of a tax holiday to decide if you want to be all in on Portugal. A lot of things can happen in 10 years. And for reference, I thought it was fun to point out that Barack Obama was just being brought into his second term of office 10 years ago. Have things changed in 10 years? You bet your butt they have. Pope Francis was elected 10 years ago. Most laptops supposedly and smartphones supposedly have a 10-year life cycle, although I think most smartphone manufacturers have figured out that they don't want that to be the case. And mine last about 4 years. And agave plants flower every 10 years. You like tequila? It takes 10 years to mature those agave plants to produce the flowers. And same-sex marriages were legalized in France, New Zealand, and Uruguay 10 years ago. 10 years is a long time for factors to shift and change. And so I would say that having 10 years to figure this thing out and become the agent of change in your own life by taking proactive measures is really the point I'm trying to make here. So you have 10 years of change and living to make decisions, and maybe work with a financial planner or some other qualified individual to look at this chart and think about this 10 years that we have to do your homework after you get NHR. So again, if you're watching this on YouTube, I've given you an opportunity here to hit pause on a very busy slide. There's so many different ways to reposition your income streams in your investment portfolio to take advantage of the 10-year holiday. All of these measures that I've described below are legal and highly effective, but of course they're situational. And so I'm going to take you through one of these scenarios just to give you an example. But I have worked through many of these with different people on various occasions, and they work well in the context of a financial plan. So the one that I like most, because it shows up the most frequently, is that you can perform a Roth conversion strategy that's complementary to the way that tax law works here. Because tax law works differently now, doesn't it? So under the normal domestic circumstances, if you were to stay in the United States forever, Roth IRA conversions can be a powerful thing. But if you're going to be moving to Europe, specifically Portugal, then things will be different. They just will. And so we need to consider those things as we lay out a Roth conversion strategy. Number one, during the tax year, the 10-year tax holiday, there isn't going to be a tax assessment. If you do this right, there's not going to be a tax assessment for moving your assets from account to account. So you take an IRA distribution, you move it to a Roth IRA, you're not going to be assessed a tax in Portugal for this. Those tax assessments are still going to be due in the United States, however. Track your contributions to those Roth accounts. If you stay, then those identified contributions can be withdrawn from the Roth IRA under Portuguese guidelines as a return of contribution. So the growth will be taxed, but the contributions to your Roth IRA can be taken out and moved to Portugal, and you can avoid being taxed as long as you take notes. Make sure that you save all of the records of these conversions as you do them over time. And then, again, if you're not all in after 10 years, you decide you want to go back to the great old US of A, then no harm, no foul. You've already paid out your American taxes on those Roth conversions, and then you can hopefully tap that spigot when you need to in the United States and receive the benefit of not having all of your assets clumped in a tax deferred account, but you have them in a tax neutral account. So the idea is this, it's a cake and eat it too strategy. Okay, you incorporate the best of both systems, which is in the US, you can take the tax hit a little bit early by letting the tax air out of the tax bag. Okay, and again, talk to me one-on-one if that's not making sense, because I can draw some pictures for you. It is a little complex, but so you retain the optionality to go back to the US and get the full benefit of the Roth conversion. But you can also stay in Portugal and you can take the Roth IRA funds from your Roth IRA without triggering a tax effect in Portugal. Although I don't remember if I put this, okay, I did not put this on the chart. I should point out though, that Portugal does not identify, it doesn't recognize your account as tax neutral, okay? And so hopefully as a strategy in your retirement accounts, you're also making sure that you don't go crazy on capturing capital gains. For example, if you have a share of Apple, well, a number of shares of Apple, that position is worth $1 million and you bought it for $200,000, let's talk, or let's just have you do this. Go ahead and sell the shares. And assuming you want to keep that position, let's go ahead and buy them tomorrow. Because Portugal, once you become a tax resident, is going to assess you a 28% capital gain on the sale of that position, despite the fact of it being in an IRA. Just one example of many things that are different now that you live here and you're not in the United States of America. And so where we want to get to with all of this, well, where we want to be is this blessed place where a retirement plan functions. Again, this is a page ripped straight from a retirement plan done for a client. The final result is this individual investor is withdrawing less than that 4% rate. Well, he's actually a little bit over. But you know, I'm not going to judge you. If you're close to 4%, this is the end result of a successful retirement plan, which, by the way, wouldn't be possible had you not taken measures to ensure that you are not being taxed overly during the first 10 years and the time thereafter by taking some proactive measures in controlling your tax situation. So there was a Q&A session that was originally done with this presentation. It is not going to appear here. That Q&A session is going to be initiated by you. Should you wish to contact me, please look in the liner notes for this call. I promised you that I would give you a sneak preview to some additional tips. Tip number 133 is what I'm calling this. Mind your NIF. So have you ever gotten to the end of your shopping there? Well, actually, okay. So number one, go to Portal Does Finances, and then I'm going to finish with this tip. and look at the despesas and deduções area, and you'll find that there is a rather handy dandy, there is a full tabulation here of all the expenses that you've been racking up if you've been giving your NIF at the appropriate time. So, precisa NIF com sua fatura? Sim, se faz favor, is the answer. Because as you're going through the shopping experience here, quer fatura com sua NIF? Sim. Porque every one of these different categories here represents a spending category that, whether you know it or not, you have been racking up points inside of, which will become deductions later on when you do your taxes. And transparency here, this is my tax return. And I was surprised to learn that I had a really big tax refund waiting for our family. And that is because we had been providing our NIF at the appropriate time. And we had been filling up all of these buckets. As you can see, each of these corresponding categories has a particular unique limit to it. And if you've been doing things right, you too can get the happy letter versus the negative letter at the end of the year. Don't blow this one off either. So hopefully I'm within time. If you are still with me, thank you for taking the time to listen to this presentation. Tally ho. And get in touch with me because this stuff is super important and I love my job. Be happy to share that love with you. Prazer and ciao, ciao.